Welcome back to Growth TV. I'm Katie Maloney. I am joined today by Scott Linch of Forvis Mazars and Bob Dunn of GF Data, an ACG company. Bob and Scott are fresh off a panel here at DealMAX discussing the 2025 trends in M&A, what to look for this year and beyond. So they're joining us today to discuss some of the highlights from that session. Scott and Bob, thanks for joining me on Growth TV.
Thanks for having us.
So I mentioned that session, would love to hear, for those who weren't in the room today, what some of the highlights were and, some of the key takeaways.
So I think we talked a little bit about 2024 trends and then coming into 2025. And, Bob and I have done quite a few of these sessions over the last few years. And it seems like we keep saying some of the same things like, hey, if this wasn't happening, then deal volume would pick up. And we expect in the next 6 months it to really pick up. And we're sort of in one of those spots again, unfortunately, where we have some uncertainty in the market, tariffs being a big driver of that uncertainty. We had the elections kind of holding things up a little bit, and now with the tariffs, it's just with so many different industries that it impacts, it really is impacting timing of deals, when deals are going to market. And so, again, we think that some of this will settle down over time when people figure out how to diligence the impacts of it, and some of it may go away. And we do think that the second half of the year should be, a bigger half of the year from an M&A perspective. So, Bob?
Yeah, I completely agree on it. It seems like it's one thing after another, Scott, right? You go from COVID and the impact of COVID. Obviously, that was more than 5 years ago, but you had 3 years to try and get a clean look at earnings and revenue on that. Obviously, there was a lot of distortion going through the COVID period. We hit that point in 2024 or mid-2023, but the debt markets wouldn't cooperate, and now debt markets started to go into better shape, cost of capital going down, debt coverage going up, look positive signs on it, but then now you have tariffs on it, which I think was promised by the administration, but I think that promise was kind of maybe not, but it's been it definitely been an impact on the market. I think it's kind of pushed things to grind to a halt at the moment.
Mm-hmm. And tariffs have been a major topic of conversation at the conference, uncertainty overall, really. So I was hoping you could talk a little bit more about that and just some of the challenges that you're seeing within the M&A space, Scott.
Yeah, so tariffs obviously a big one. That's a headliner, but it's the other things too that it's impacting us. It's immigration, it's interest rates, which the tariffs are going to impact. Inflation is looking like it's in a better spot at times. But until these, we kept saying until interest rates start going down, it's going to M&A market's not going to come back completely. And so with tariffs, pushing that to pushing the interest rates out a little bit on some of those decisions is probably impacting deal flow. And then immigration can affect so many different industries, and it may not be the company that they're buying. It could be the subcontractors that it impacts, but it can impact our workforce, and that really drives some of these middle market businesses.
Yeah, and I think, looking at it more broadly, stock market performance, which obviously has been significantly impacted by tariffs, and I feel like even though there's a disconnect between public markets and private markets, there's still, some connection across there. Someone sees their portfolio going down, individual owning a business, that might not seem like a good time to sell the business if the rest of the portfolio is going in negative territory. So I think, it is kind of related on it, but it is that, where are things going to land? And, it's very difficult to map out an ROI when you have that uncertainty in the marketplace.
And we talked a little bit about upstairs around add-on activity is sort of an all-time high, as well as continuation funds and other vehicles that people are using to extend the hold period of some of these assets. And I think one of the statements upstairs was, well, holding it doesn't necessarily make it okay. It still could. The company still, it might not be the best solution, I guess, to just hold it for longer. And so it'll be interesting to see when those ultimately trade, how that works out in the market. But the last stat that we heard was, deal activities we expected to grow like 25% this year, and now it's down to 7% with some of the predictions. I'm sure there are other predictions out there, but I think we were kind of like 7%. We might take that, right?
Yeah. I mean, that's better than the alternative, right?
Right.
Well, in a recent article that you authored, Bob, I believe it's called "Ado Add-ons." Does that still hold?
I might be walking that back now.
Okay.
Yeah, I mean, I think, if you looked at the last year in terms of what GF Data tracked, we were at midpoint of the year through 2 quarters of 2024, 44% of deals we tracked were add-ons. That's extraordinarily high average. 2023, it was 35%, 2022, 32.5%. So we're at an we're at an accelerated period in terms of add-on activity, and I view add-ons as kind of wait and see, right? It gives you something to do, relatively low risk. You can invest some capital, not too much, and you bolster the value of existing portcos, but it is kind of something you do while you're waiting to make new platform investments, and that really hasn't been happening yet. It seemed like we got to the end of the year, it was at 40%, so more platform activity, obviously, versus add-ons happening in the last 2 quarters of 2024. Expect that to continue, but then with this uncertainty on it, I feel like the move to add-ons is a decision based upon risk. We're in a risk-on environment again, admittedly for different reasons than we were before, but I'm not so confident that it is a due add-ons anymore. And the other thing too is that, we're basically on percentages. I just think in this environment, there are going to be fewer platforms. Whether or not there are more add-ons, that's going to be a higher percentage of add-ons regardless, because the platform investments are going down.
Well, another metric that GF Data tracks is the premium paid for top performing businesses. So I wondered if you could speak about that, what the data is showing and what that kind of tells us about this environment.
Yeah, so the quality premium is something we've always thought was very interesting. So for GF Data, for deals that we track, we go in and attribute companies that have greater than 10% trailing 12-month EBITDA margin and greater than 10% trailing 12-month revenue growth, and it needs to be above 10% for both of those metrics into a above average financial performing company category. And then those companies that are underneath that end up in a separate category on it. And we've always looked at the delta between those two and the incidence of the above average financial performing companies to be a good barometer of the health of the marketplace. Middle of 2024, we ended up with just 37% of companies as above average financial performers that transacted. That compares to an average of 56% historically, so well below on it. And the premium pay was just 7% compared to a historical average of 15% on it. Two factors at that were the above average financial performers are not as above average as they used to be. So where we might have seen, a 15 and a 30% or a 12 and a 25%, now we're seeing, in many cases, negative revenue growth. So that pulls companies entirely out of that category, or just kind of barely making that level of above average financial performance. So valuations there have gone down, which led to kind of the smaller delta between the above average and everyone else in the market. And then the incidence also went down on it. The other thing that we've seen is with more add-on activity out there, the non-above average financial performers are actually seeing higher valuations because there's more competition for those smaller companies as add-on investments. That's driven prices up, and the above average financial performers are not garnering the same prices they had before. Positive side, by the end of the year, incidence in these companies was up to 40%, so still well off that 56% historical, but improving off the middle of the year. And the premium was up to 15% compared to 7% midway through the year. So going in the right direction again, but it's a challenging crop of companies that transacted in 2024, I think. And I think, Scott, you'd have a perspective on that as well.
Yeah, I think that some of the trends we talked about earlier, the good companies are maybe being held longer. Add-ons are a big part of the game. So some of these platforms just aren't being sold. And when you have a higher percentage of platforms going to market, I think those are going to be really high-performing companies typically. And so you're not getting as good assets out there. But I do think that that's going to, continue to change because people have to get liquidity in some way. The continuation funds solve that problem for a period of time, but then you can't do that with all your portfolio, and you need to keep trading these assets to get liquidity back to your LPs. The one thing I wanted to mention about upstairs was we did take a poll, and so a little bit of a Vegas take on the poll was 7% growth of M&A activity this year. Who would take the over and who would take the under? And I didn't see a whole lot of overs in the audience.
No, there
were more overs on stage, I think, than out in the audience, which is a little concerning. So I think we definitely had a pessimist sentiment there, and so we're hoping it'll be a little different. But I did take the over on the second half of the year being better than the first. So I think that's what we all project will happen. It just kind of has to once things settle down a little bit.
Yeah, it'll be interesting to see how the situation evolves over the course of the year. And I know we'll have you back for some quarterly updates. So we'll check in again then. But really appreciate you joining us today. Thank you, Scott. Thanks, Bob.
Thank you.